the SEC clamping down on top of hedge funds, pensions, or anyone else in the space who wants to work with crypto.
That's right. The SEC is clamping down on this space big time. If you've been watching or paying attention, then you know that the last two episodes that I reported on were the staking as a service crackdown by the SEC on the Kraken site. So you can't stake your coins with centralized providers. And we'll see how that plays out with Coinbase. I'm sure Coinbase is a pretty big staking business. Also, the last one I announced was the Paxos Wells notice from the SEC, where they said that you got to stop this Binance USD stablecoin business that you're in, and Paxos said they're going to sue. Well, today we're going to be talking about custody. What is custody? Custody means who holds your crypto. Well, if you're a fan of this channel, then you do not want anybody holding your crypto. You probably want to hold at least the bulk of your crypto in cold storage. Now, of course, this is not financial advice. This is my opinion, and you could use links below to do your own research. But the important thing is, like, who holds your crypto when you're holding it, keeping your crypto with a centralized entity. Well, the SEC is coming out and saying that you need to hold your crypto with a qualified custodian. And what does that mean for crypto? Well, let's jump right in. I'm going to share my screen, and you can listen up, and you can use the links below to follow along. Okay, so this is an article by Jesse Hamilton, and it's titled Coinbase Anchorage Digital say they'd be okay under SEC custody proposal rule, but risks may lurk for others. And then it says the U.S. Securities and Exchange Commission's proposal to require investment advisors use only qualified custodians could complicate advisors' use of crypto platforms. So I think this is a really interesting story. I do think that the custody situation in crypto needs to be handled. So this is clarity, I guess you could say. I mean, not I guess, this is definitely some clarity. Now, this is just a proposal. There's a 60-day window for comments from the public, but this was as of 4 days ago, so you have 56 days and counting. And so what I'm showing you right now is a press release from the SEC, and it's titled SEC proposes enhanced safeguarding rule for registered investment advisors. So I think that this is interesting because it's specifically talking about registered investment advisors. Now, I do think that the general custody concept is coming. I do think that any company who holds on to your crypto for you, I do think that they should be a qualified custodian, in my opinion. I do think that. And so what does that mean? So I highlighted a piece from this press release, and I'm going to just read it for you. The proposed changes are intended to help ensure that qualified custodians provide certain standard custodial protections when maintaining an advisory client's assets. Now, this says advisory clients, but I'm going to just go out on a limb here and say that in general, custody should be with a qualified custodian. So it continues, these protections are designed, among other things, to ensure client assets are properly segregated and held in accounts to protect the assets in the event of a qualified custodian bankruptcy or other insolvency. See, so there you go. If you think of Celsius, the judge in the Celsius case said the assets that you gave to Celsius are not yours. They're Celsius's, and they can do what they want with it. And you're just on the short end of the stick because you gave your money to Celsius. Now, that applies to that extrapolates out to Voyager and BlockFi and FTX. Like, just because you put your money onto those platforms doesn't mean that it's your money anymore. They owe you that money. You're a creditor, and go stand in line at the bankruptcy court, like Gary Gensler said. And I hate to kind of agree with some of this stuff because I think Gary Gensler has done a terrible job and doesn't seem to be protecting investors, but this does seem to kind of start the process. However, I'm going to tell you why I'm a little skeptical in just a second. So let me finish reading this. It says, additionally, the proposal retains the current requirement for an advisor with custody of client assets to obtain a surprise examination from an independent public accountant to verify client assets. But it would modify the audit provision to expand the availability of its use, enhance investor protection, and facilitate compliance. So, for me, I think that this is the biggest thing here. I think to pay attention, because I like the surprise audits. You imagine, like, especially like a stable coin. I know this is not for stable coins, but now we're starting to kind of get the language and the ideas out there that I like. I like USDC. I like anybody who's like a qualified registered stable coin, which I know we don't have the rules for that yet, but I'm just kind of like, what's it called? When I'm looking into the future, this is kind of like oh my gosh, hypothesizing, theorizing. I can't think of the word. Anyway, speculating. There you go. I'm speculating that or predicting. I'm predicting that there will be stablecoin rules and like surprise audits will be part of it. I have no problem with the cost of a surprise audit for Coinbase or Uphold or Binance US. I'm a little weary about Binance US. I don't like Binance US, by the way. I don't like Binance, period. And I'll tell you why a little bit. So anyway, like if we had these kind of surprise things and we had custody rules, I know this is for investment advisors, but if we had rules like that, then maybe FTX would have been caught and everybody would have lost their money. Voyager, where were Voyager's assets at? They were on loan there. They were loaning it out. I don't know. So I think it's important that this custody rule, anyway, I'm going to keep moving on, but I think this sounds good, but let's dig in a little bit more. I'm going to go back to that article that we listened to Jesse Hamilton give us a little update here. So I'm going to just play you a little bit more video for this. Okay. This is less than a minute long. Let's go.
Yesterday, the report was from Reuters, and now we're going to talk about it from the CoinDesk angle, which basically breaks down the fact that Gary Gensler and a lot of other people at the SEC are not fans of crypto, and they want to protect traditional finance from crypto. And really, they're pulling away a lot of power from crypto custodians' hands and moving it into traditional finance. So according to this piece we have here, which definitely go check out.
Okay, so I don't know if I said this already, but this is not financial advice. This is for entertainment purposes. You can use the links below to do your own research. I am not a qualified or a certified financial accountant, certified financial planner, advisor. I am not a lawyer. So there we go. I just had to say that. Okay, so what he just said here was that the SEC is trying to take the power away from, or kind of give power to the banks. Let's listen to that tiny little piece again that he just gave us. There we go.
A lot of power from crypto custodians' hands and moving it into traditional finance. So according to this.
Okay, moving the power of custody into the traditional TradFi. Okay, so if you've been paying attention, then most of the major banks had made announcements that they are trying to solve the crypto custody thing. Over the course of my show, I've reported at least 3 major banks are working on crypto custody. And I was always like, that doesn't even sound very exciting, but I guess it makes sense because they're going to have some sort of custodial process set up for their clients in order to be compliant and to make people feel safe. It's like, oh, your crypto is being held separately from everything else. You don't have to worry. And now this whole thing is happening. It sounds a little suspect. I'm just saying. All right, keep going.
This piece we have here, which definitely go check out on the website. You see that Gary Gensler and other commissioners at the SEC, they want to allow only traditional finance companies with a lot of the regulatory checks that are in place today to be able to custody funds. The rationale.
So there you go. He just said it again, that the current TradFi system is set up to protect investors from the problems that we encountered with these lending platforms, and specifically FTX. So this rule is the beginning of pushing custody into qualified custodians, which have to be, and you'll hear this in a second, chartered banks, trusts, OCC compliant certification, registered banks, etc. Here, I'll just wait for it. 1 second. Sorry, I'm getting ahead of myself.
For that, basically goes into the commingling of funds. If I have token A and token B in a treasury and they're supposed to be in different places, well, a lot of these crypto firms historically have just put those funds all into one address or one wallet, and that's led to a lot of loss of funds. As Gary Gensler says in this piece, you end up with a lot of people in line at bankruptcy. Sort of a wink and a nod to FTX, which definitely was the case there, where they were commingling a lot of funds. The thing I have here, the nitpick, maybe it's not even a nitpick, it's just kind of calling it out. The fact that they're using this FTX case as an
Yeah. Okay. So yes, FTX is just being used as an example for why the feds want, Congress and regulators want to crack down on crypto in an overly aggressive way. I would agree with that opinion. Okay, so let's dive into this a little bit and just kind of break it up a little bit here. So the first thing I want to do is read to you. Okay, so now we're going after the custody, like putting your money all in one wallet and hoping that these centralized exchanges can keep track of your stuff, and hoping that there's no bad actors has led to tons of collapses and people losing their money. So this custody situation, I'm totally on board with, but let's dig in. So the first thing is some good news is it says here, the state chartered trusts that many crypto businesses use for custody, such as Coinbase's custody trust company and BitGo, look like they're qualified for the role. So that's a huge positive right there. That means like that two of the players that are in crypto are good. Now it does say that this is from Coinbase's chief legal officer. He says, after today's SEC proposed rulemaking, we are confident that Coinbase Custody Trust Co. will remain a qualified custodian. And then Anchorage Digital comes about and says, Anchorage Digital Bank, the first and only fully operational OCC chartered digital asset bank, is unequivocally a qualified custodian, says the company's general counsel. While Anchorage Digital would be largely unaffected by the proposed rule, we plan to work with all stakeholders to ensure any transition results in minimal disruption to digital asset ecosystems. Okay, so there you go. That's Anchorage Digital Bank, Coinbase, and then BitGo. And it says, let's see, BitGo makes this comment statement down here, and I'll read it for you. It says, many exchanges, crypto lending and trading platforms, and software providers hold themselves out as custodying crypto assets, said Jeff Horowitz, chief compliance officer at BitGo. BitGo offers fully regulated and qualified custodians via state chartered trust companies in both South Dakota and New York. So that's three crypto players that are good. Okay. So I think that's important to point out. And now I just want to point something else out here, which is, let me see. Okay. All right. So within the SEC, they have some people with differing opinions. It says SEC Commissioner Mark Uyeda seemed to hit on one of the potentially alarming pieces of the agency's proposal for the industry. It potentially cuts out crypto exchanges. And he's quoted here saying, because crypto assets trade on platforms that are not qualified custodians, an advisor that trades crypto assets on a platform would violate the proposed rule. Ueda continues on and says, how could an advisor seeking to comply with this rule possibly invest client funds in crypto assets after reading this release? Boom. That's when you start to realize, yes, going after custody, some of these things and this language is good. But then when you dig in, then you realize that, wait a minute, you're basically cutting out crypto exchanges from crypto advisors, which means advisors can't basically use these crypto exchanges. So how are they supposed to facilitate activity in crypto and if they have a fiduciary responsibility to advise their clients on what is in their best interest, and if they think that crypto is in their best interest, then they can't uphold their fiduciary responsibility under this rule. How about that for an interesting take? Please leave a comment below if you have another perspective. I'm going to continue on. He argued the proposal takes great pains to paint a no-win scenario for crypto assets. And though he voted in favor of moving forward with it, he said this approach appears to mask a policy decision to block access to crypto as an asset class. And then the chief policy officer at the Blockchain Association just adds to it and says it would flagrantly violate the SEC's mission by making investors less safe. So I don't know what you think about that, but to me, this is kind of fishy. Okay, let me read one more thing. The SEC proposal said the current list of companies providing custody of crypto assets includes, so this is SEC saying who can hold crypto. 1 OCC regulated national bank, 4 OCC regulated trusts, approximately 20 state chartered trust companies and other state chartered limited purpose banking entities, and at least 1 futures commission merchant. So they're saying that these are the company that are providing crypto assets, or sorry, custody of crypto assets. So all of these people are banks. And guess who just issued a statement saying that banks should not work with crypto companies? The Fed and the OCC have come out and said that, oh my gosh, this is so crazy. It's like the SEC is like, oh, hey, as investment advisors, you got to make sure you're using a proper custodian. Oh, wait a minute. The exchanges aren't proper custodians, so you might not be able to trade. Oh, and by the way, if you want to know who are proper custodians, it's basically banks. And then the banks are like, well, I don't know if I want to work with these people because now I'm being told that by the Fed and the OCC and the Treasury, like, don't mess around with crypto companies. So basically, what the dude said in the interview, in the video I just played for you, is basically sounds pretty legit. It sounds like it sounds like a coordinated effort to push crypto to the fringes. Now, I will say this: whether it's a concerted effort or orchestrated or effort by the government to attack crypto, I don't know. But what I do feel very confident is that they do not, I mean, they've already said this, they do not want, they as in the banking regulators, they do not want crypto mingling with TradFi because they're worried that it would pour over and create contagion in the markets that could bring down TradFi. Even though crypto is like less than 1% the size of the traditional banking sector. Anyway, what do you think about that? Let me know. Leave a comment below. I'd love to hear from you. Are you worried? Are you not worried? Are you buying? Are you selling? Let me know. I want to hear from you. Have a good day. Hodl on.